David, I'll start with you and welcome to you both. So we have a lot of things. We have the remarks from Chair Powell. We have the Moderna news and so much more. Are we getting kind of too ahead of ourselves here about what this all means to the economy? Or are we frankly, moving into that period of time where we're getting back to normal and the valuations make sense to you here?
Well, from a valuation perspective, we're definitely not normal. We're still very, very high. But it is good news. It's welcome news. We all want this to work. We all hope it does work. So we're positive about that. From a market's perspective, we've seen the market recover. And it's hard to fight against the Fed, right? But if you look at the economy, on the other hand, we're struggling. And there's a separation there. And that separation is larger than it's been in other down markets and other recessions. And it takes time. I wouldn't bet against America, that is for sure, but I would bet on some companies doing well in this time frame. So, I mean, we're still cautiously optimistic, looking for the buys and the right opportunities, but watching out for those overvalued stocks.
As you say, Amazon is a top holding. You like a lot of big health and pharma names. Zoetis also has come up a lot. That's one of your favorites. But I want to go back to what you said about valuation, especially if these are some of the names that you like. When you say that we're still very, very high, explain that a little bit more. I mean, are we high in the sense that we've been structurally higher for most of the last decade plus, or do you think right now, compared with last year, valuations are too high?
Well, I think from a standpoint of the market fundamentals, what earnings are happening, we have companies that are not earning as much as they need to. They are not having to be, they're having struggles with employment. We have 35 million plus people unemployed right now. That's the economy. That's the reality of the fundamentals. When you have companies like Zoom, which is more than all 7 of the top airlines combined, its valuation is very, very large. And the CEO came out and said, hey, we're not going to make too much money here off these clients. So I think you do have some companies that are overextended in this market, but you still have some. You mentioned Zoetis. I mean, we're a big believer in healthcare and pharma and the big names out there like Eli Lilly and AbbVie. But Zoetis here, we like our pet friends. They increased 12% in the second quarter in that market share. Great balance sheet, great company, growing. That's a good name to be into now.
No, but you know what? You can't train your dog to bring in, well, I guess you could train him to bring in the newspaper, but you couldn't do it with your cat. And I'm telling you, my 2-year-old's getting pretty good at bringing in that newspaper. And I mean, it's like if my dog from growing up brought in the newspaper, I'd be just as amazed. Michael, let me move on, talk to you a little bit about fixed income and what's happening on the bond yield side. Wednesday, we have the 20-year note being auctioned for the first time ever. Is this an appropriate move? Should we be doing more longer-term debt for the U.S. economy? Or would markets support that? What are your thoughts?
Well, it's a good question. And certainly there's a lot of government bond issuance by the U.S. Treasury as well as lots of other governments around the world to fund their fight and the economic dislocations caused by the pandemic. So terming some of the debt out makes a lot of sense. I mean, the 30-year Treasury is under around 1.3% or so. So it's a very low long-term interest rate by any historical comparison. So terming it out makes sense because the long-term interest costs are not that high. On the other hand, if this is a short-term phenomena, do you want to lock in long-term debt at these yields for a long, long time? And it probably still makes sense from that perspective because they're so low. But so I think it's a good policy of the Treasury to fund themselves across the maturity spectrum and not overload the Treasury bill market or the front end of the yield curve, assuming that it'll go away in a short period of time. But it's putting somewhat pressure on long-term interest rates.
Let me circle back also to what the Fed chair said last night. I mean, is it news to you that he says they're never going to be out of ammunition? They can continue to do more to support these markets?
I think that is not news to me. I'm an economist by training, and I'm a big believer that central banks have not unlimited firepower, but certainly if you're the United States and the size of the United States economy, plus its status as the dollar's status as a reserve currency, really help the U.S. Be able to run very aggressive policies, both fiscal and monetary. So effectively, the Fed can do what the Bank of Japan did and buy up every treasury that the Treasury auctions along the way and fund the entire deficit and print money along the way. With inflation going down, not up, there's no immediate concerns about the inflationary consequences of what they're doing. So, yes, they can just keep printing money as long as they like, unless it causes some kind of major inflation problem.
Yeah. All right. Got to leave it there. David, you're not investing in any energy names, are you?
Not right now. We're still cautious there. There are some good names out there that are creeping up, like Chevron and Exxon, with great balance sheets, but we're a little bit more looking at the consumer, and it's very low demand in energy right now.